The complete beginner's guide to the stock market. Foundations, mindset, and why investing matters. Have you ever wondered what the stock market really is? Why is it that some people build fortunes that last for generations, while others treat the stock market like a casino and somehow manage to lose everything? By the end of this full video guide, you will understand how the stock market actually works, how people truly make money in it over time, and how you can begin investing with confidence even if you're starting with as little as $50 or $100. This is not a hype video. This is not a get-rich-quick pitch. This is a complete foundation for understanding investing the right way. I strongly recommend that you take this video at your own pace. Grab a notebook, pause when needed. Rewatch sections if something doesn't click the first time. This is a long guide on purpose because real financial understanding takes more than 5 minutes and a motivational quote. On the screen now, you'll see a table of contents outlining everything we'll cover today. This includes why investing matters, how much money you can realistically make, stock market terminology, portfolio construction, risk management, research methods, real examples, and live demonstrations later in the video. Everything will be timestamped so you can always return to specific sections when you need them. Let's start with the most important question of all, why you should invest in the stock market. Before we talk about stocks, charts, or portfolios, we need to address the why. It's why invest at all? Why not just save money in the bank and avoid the stress? The answer begins with understanding how money behaves over time. The reality of cash and time. When money sits still, it slowly loses value. This happens because of inflation. Inflation means prices rise over time, and the same amount of money buys you less in the future than it does today. You've seen this firsthand. A movie ticket that once cost $5 now costs $15. A cup of coffee that once cost $1 now costs $5. Rent, groceries, healthcare, education, transportation, everything trends upward over long periods of time. If your money is not growing faster than inflation, you are falling behind, even if your bank balance looks the same. The stock market as a wealth building tool. The stock market exists as a mechanism for people to own pieces of productive businesses. When you invest in stocks, you are not gambling on numbers moving on a screen. You are buying ownership in companies that sell products, generate revenue, employ workers, innovate, and grow. Over long periods of time, productive businesses tend to become more valuable. That growth is what investors participate in. Understanding the S&P 500, one of the most commonly referenced benchmarks in investing is the S&P 500. This index tracks approximately 500 of the largest publicly traded companies in the United States. These companies represent a wide range of industries, including technology, healthcare, finance, consumer goods, energy, and more. What makes the S&P 500 so important is its historical performance. Over many decades, it has consistently trended upward, producing an average annual return of roughly 8 to 10% over long time horizons. That does not mean it goes up every year. Some years are negative, some years are spectacular. But over time, the overall trend has been growth. This matters because it shows that investing is not about predicting the perfect moment. It's about participation over time. Stocks versus other asset classes. When we look back over the last century, stocks have outperformed most other major asset classes. Treasury bonds provide stability but lower returns. Cash offers liquidity but almost no growth. Gold preserves value but rarely compounds meaningfully. Real estate can be powerful but requires capital, leverage, and management. Stocks, on average, have delivered the highest long-term returns for passive investors. This is why nearly every long-term wealth story eventually involves ownership of businesses, making your money work for you. One of the most important shifts in thinking happens when you stop trading time for money and start letting money work for you. When money is invested, it can generate returns without your direct labor. This is where compounding begins. Understanding compound growth. Compound growth means earning returns on both your original investment and your accumulated gains. Imagine investing $1,000 and earning 10%. After 1 year, you have $1,100. The next year, you earn 10% not just on the original 1,000, but on the full 1,100. This snowball effect accelerates over time. At first, growth feels slow. Then it becomes noticeable. Eventually, it becomes powerful. This is why time is the most valuable asset an investor has. Not timing, not predictions. Time. Inflation, the silent wealth killer. Inflation does not announce itself loudly. It erodes quietly. If inflation averages 5% and your money earns 0%, your purchasing power is cut in half in about 14 years. This means saving alone is not enough. Saving is necessary for emergencies. Investing is necessary for growth. A simple example, decades ago, mailing a letter cost a few cents. Today, it costs many times that. The stamp did not change. The service did not change. The currency did. Investing is how individuals protect themselves from this gradual erosion. How much can you really make? This is one of the most common questions beginners ask. The honest answer is, it depends. But we can talk about realistic expectations. Average market returns. Historically, broad stock market indexes have returned roughly 8 to 10% per year over long periods. That number includes crashes, recessions, booms, wars, and recoveries. Some years will be negative. Some years will be extraordinary. The average matters more than any single year. A realistic long-term scenario. Let's imagine a person earning an average income. They start with a small amount of savings and invest consistently every month. They don't chase trends. They don't panic sell. They keep investing through ups and downs. Over decades, this behavior often leads to seven-figure portfolios, not because of genius, but because of consistency and time. Most wealth in the stock market is built slowly, then suddenly. Time in the market versus timing the market. One of the biggest mistakes beginners make is waiting for the perfect moment. They wait for a crash. They wait for certainty. They wait for confirmation. By the time everything feels safe, prices are usually higher. History repeatedly shows that staying invested beats jumping in and out. Even investors who bought at seemingly bad times often did well if they stayed invested long enough. The market rewards patience more than precision. What the stock market actually is. At its core, the stock market is simply a marketplace. It is where buyers and sellers trade ownership, shares of companies. When you buy a stock, you are buying a small piece of a business from someone else who is selling it. The price moves based on supply, demand, expectations, and information. That's it. It's not mysterious. It's not magical. It's a system for allocating capital. Why companies go public? Companies sell shares to raise capital. This money can be used to expand operations, invest in research, hire employees, acquire competitors, or strengthen the balance sheet. Going public allows businesses to access a much larger pool of investors. In return, investors gain the opportunity to participate in the company's growth. Essential stock market terminology. Foundations. Before going further, it's important to understand basic language. Bull markets and bear markets. A bull market means prices are generally rising and optimism is high. A bear market means prices are falling and pessimism dominates. Markets move in cycles. Both are normal. Market capitalization. Market capitalization refers to the total value of a company's outstanding shares. It helps investors understand company size and risk profile. Smaller companies tend to be riskier but can grow faster. Larger companies are more stable but grow more slowly. Indexes. An index tracks a group of stocks. Instead of picking individual winners, an index represents the collective performance of a market segment. Dividends. Some companies share profits with shareholders through dividends. These payments can provide income and can be reinvested for compound growth. How stocks are categorized. Stocks are often grouped by size, sector, and theme. Size categories. Microcap companies are small and volatile. Small caps offer growth but risk. Mid caps balance growth and stability. Large caps dominate industries and provide consistency. Sectors. Technology, healthcare, finance, energy, consumer goods, industrials, and more. Diversification across sectors reduces risk. Investment themes: growth, value, dividends, innovation, emerging markets, defensive strategies. These themes help investors align portfolios with goals and preferences. Beginner investment approaches. There are two primary paths for beginners. Individual stocks, higher potential upside. Higher risk, requires research and emotional discipline. Index funds, broad diversification, lower fees, historically reliable returns. For most beginners, index funds provide the simplest and safest starting point. The importance of accounts. To invest, you need the right type of account. Brokerage accounts allow flexibility but are taxable. Retirement accounts offer tax advantages but have rules. Understanding these accounts is critical for long-term success. At this point, you now understand why investing matters, what the stock market is, and how money grows over time. Now we need to talk about something that separates successful long-term investors from everyone else. That difference is not intelligence, luck, or even income. It is structure and behavior. Most people do not lose money because they picked the wrong stock. They lose money because they had no plan. They invested emotionally, they panicked, they chased trends. They abandoned strategy the moment discomfort appeared. So in this part, we are going to focus on how to build a portfolio correctly, how to think about risk, how to decide what belongs in your portfolio, and how to avoid the most common mistakes that destroy returns. Before buying a single stock or fund, you must understand yourself as an investor. Every investment decision you make flows from three personal variables: risk tolerance, time horizon, and financial goals. If you get these wrong, even good investments will feel unbearable. Risk tolerance is your ability to emotionally and financially handle losses. This is not theoretical. This is how you react when your portfolio is down 20% and headlines are screaming that the economy is collapsing. Some people say they are fine with risk until they experience it. Then they sell at the worst possible moment. Risk tolerance is not about maximizing returns. It is about staying invested. If you build a portfolio that is too aggressive for your personality, you will sabotage yourself. If you build one that is too conservative, you may fail to reach your goals. The correct portfolio is not the one that looks best on paper. It is the one you can hold through market cycles without panic. Time horizon is the second variable. This refers to how long you plan to invest before needing the money. Money invested for retirement 30 years from now can tolerate short-term volatility. Money needed for a home down payment in 2 years cannot. This distinction is critical. The stock market is not dangerous over long periods. It is dangerous over short ones. Over 1 year, the market can do anything. Over 5 years, uncertainty shrinks. Over 20 years, history shows remarkable consistency. If your time horizon is long, volatility is not your enemy. It is the price you pay for growth. If your time horizon is short, volatility can be catastrophic. Goals are the third variable. Are you investing for retirement, financial independence, income generation, wealth preservation, or growth? Different goals require different portfolios. Someone in their 20s building wealth will look very different from someone in their 60s preserving it. Once you understand these three variables, portfolio construction becomes logical instead of emotional. One of the simplest and most effective portfolio structures ever created is known as the three-fund portfolio. This strategy was popularized by long-term index investors who recognize that beating the market consistently is extremely difficult, even for professionals. The three-fund portfolio is built on a simple idea: own the entire market at low cost and let time do the work. It consists of three components. The first is a total US stock market fund. This gives you ownership in thousands of American companies across all sizes and sectors. The second is a total international stock market fund. This gives you exposure to companies outside the United States, including developed and emerging markets. The third is a bond fund. Bonds reduce volatility and provide stability during market downturns. Together, these three funds create diversification across geography, industry, and asset class. You are not betting on one company, one country, or one theme. You are betting on global economic growth. The exact allocation between these three components depends on risk tolerance and time horizon. A younger investor might allocate heavily toward stocks and lightly toward bonds. An older investor might reduce stock exposure and increase bonds. There is no perfect allocation. There is only appropriate allocation. The power of the three-fund portfolio lies in its simplicity. Low fees, broad diversification, minimal maintenance. It removes the temptation to constantly trade. It removes the stress of picking winners. It allows investors to focus on behavior rather than predictions. Another beginner-friendly approach is a core and satellite portfolio. In this structure, the core of the portfolio is made up of index funds that track the market. The satellite portion consists of individual stocks or thematic investments used for additional growth or personal interest. For example, 80% of the portfolio may be invested in broad index funds, while 20% is allocated to individual companies you believe in. This approach provides stability while still allowing room for conviction and learning. The key is discipline. The core should remain intact regardless of market noise. One of the biggest mistakes beginners make is overconcentration. They fall in love with a single stock, a single sector, or a single trend. They load up on technology stocks during tech booms. They chase energy during commodity spikes. They pile into speculative themes during hype cycles. When that sector underperforms, the entire portfolio suffers. Diversification does not eliminate risk, but it prevents catastrophic failure. You do not need to own everything, but you should avoid owning only one thing. Another common mistake is overtrading. The more often you trade, the more opportunities you have to be wrong. Frequent trading increases taxes, fees, and emotional decision-making. Long-term investing rewards patience, not activity. Doing nothing is often the most profitable move. Rebalancing is one of the few actions long-term investors should take periodically. Rebalancing means adjusting your portfolio back to its original target allocations. For example, if stocks perform very well and bonds lag, stocks may grow to represent a larger portion of your portfolio than intended. Rebalancing involves selling some of the outperforming asset and buying the underperforming one. This forces you to buy low and sell high in a systematic way. Rebalancing should be done infrequently, typically once or twice per year. It is not a trading strategy. It is a risk management tool. Now let's talk about volatility, because this is where most investors fail. Volatility is normal, it is expected, it is unavoidable. Markets do not move in straight lines. There will be corrections, there will be crashes, there will be periods where nothing seems to work. These moments feel permanent when you are in them, but history shows they are temporary. Every major market decline has eventually been followed by a recovery. The investors who benefit from those recoveries are the ones who stayed invested. The investors who sold during fear locked in losses and missed rebounds. This is why emotional control is more important than intelligence. You do not need to predict recessions. You need to survive them. One way to manage emotional risk is through dollar cost averaging. Dollar cost averaging means investing a fixed amount of money at regular intervals regardless of market conditions. When prices are high, your fixed investment buys fewer shares. When prices are low, it buys more. Over time, this smooths out entry points and reduces the pressure of timing decisions. It also creates discipline. Instead of asking whether now is a good time to invest, you simply invest. Consistency beats cleverness. Another powerful concept is asset location. This refers to placing different types of investments in different types of accounts for tax efficiency. For example, assets that generate frequent taxable income may be better suited for tax-advantaged accounts. Assets intended for long-term growth may benefit from tax-free structures. While this becomes more important as portfolios grow, understanding it early helps avoid costly mistakes later. Now we need to address one of the most dangerous myths in investing, that higher returns require constant action. Many beginners believe they must always be doing something, checking prices daily, reading news obsessively, reacting to headlines. In reality, the best investors spend very little time managing their portfolios. They set systems, they automate contributions, they rebalance occasionally, they ignore noise. Markets reward those who can sit still. This is counterintuitive in a world designed to capture attention. Media profits from fear and excitement, not patience. Most financial news is irrelevant to long-term investors. If your investment horizon is decades, daily market movements do not matter. What matters is earnings, growth, productivity, innovation, and time. Now let's talk about expectations. Many beginners enter the market expecting fast results. They see stories of overnight millionaires and viral stock wins. These stories are rare, survivorship biased, and often misleading. Real investing is boring. It is slow in the beginning. It tests patience. It requires consistency. The rewards come later. The first 10 years often feel underwhelming. The next 10 feel noticeable. The final 10 feel powerful. This is why starting early matters so much. Not because you will get rich quickly, but because compounding needs time to breathe. Another mistake beginners make is ignoring fees. Fees may seem small, but over decades they compound negatively. A 1% annual fee can reduce your final portfolio value by hundreds of thousands of dollars. Low-cost index funds exist for a reason. They allow investors to keep more of what the market gives. Costs are one of the few variables investors can't control. Minimize them. Now let's address market crashes more directly. Crashes are inevitable. They are the price of admission. If you cannot tolerate temporary declines, the stock market may not be for you. But here is the truth most people miss. Crashes create opportunity. They allow disciplined investors to buy productive assets at discounted prices. Every major crash in history has been followed by recovery and new highs. The market does not reward fear, it rewards endurance. The key is preparation. Emergency funds exist, so you do not have to sell investments during downturns. Stable income reduces panic. Diversification reduces volatility. A plan reduces emotional decision-making. Preparation turns fear into opportunity. Another concept worth understanding is sequence of returns risk. This is particularly important for those nearing retirement. Sequence of returns risk refers to the danger of experiencing poor returns early in retirement while withdrawing funds. This can permanently damage portfolios even if long-term average returns are strong. This is why asset allocation becomes more conservative as withdrawal periods approach. It is not about maximizing growth. It is about managing risk. For younger investors, sequence risk is less relevant. For older investors, it is critical. Now let's talk briefly about behavioral traps. Recency bias causes investors to assume recent trends will continue forever. Confirmation bias leads investors to seek information that supports their beliefs and ignore opposing evidence. Loss aversion causes losses to feel more painful than gains feel rewarding. Herd behavior leads people to follow crowds into bubbles and out of crashes. Understanding these biases does not eliminate them, but awareness helps. Successful investing is largely about managing your own psychology. Now let's talk about contribution strategy. How much should you invest? The answer is simple, but not easy. As much as you can consistently invest without jeopardizing your stability. Start with what is realistic. Increase contributions as income grows. Automate investments so willpower is not required. Consistency matters more than starting amount. $50 invested regularly is more powerful than $1,000 invested once. Now let's talk about patience again, because it cannot be overstated. Markets reward long-term thinking. Every day you stay invested increases your odds of success. Every time you avoid panic selling, you compound not just money, but discipline. This is why investing is less about numbers and more about behavior. In the next part, we will go deeper into evaluating individual stocks, understanding financial statements in plain language, distinguishing speculation from investing, and learning how to research companies intelligently without becoming overwhelmed. When you are ready, tell me. Thank you so much for sticking with me all the way to the end of this guide. I truly appreciate you spending your time here and taking your financial education seriously. If this video helped you understand the stock market more clearly, gave you confidence, or saved you from making costly mistakes, please take a second to like this video. It really helps support the channel and lets me know this content is valuable to you. If you want more videos like this covering investing, building wealth the right way, and making smarter financial decisions over the long term, make sure you subscribe to the channel. New videos are posted regularly, and subscribing ensures you don't miss any future guides. Feel free to leave a comment below with your questions, what part of the video helped you the most, or what topics you'd like to see covered next. I read through the comments and use them to shape future content. Thanks again for being here, for investing in yourself, and for taking the first steps toward building real long-term wealth. I'll see you in the next video.